Hello and welcome to BQ Prime. You're watching Earnings with BQ, and our guest today is Mr. Gopal Balachandran, the CFO and CRO of ICICI Lombard General Insurance. The company came out with its results yesterday evening, and its net profit is up 12%, and net premiums earned are also up 12%. Its overall revenue is up around 14%. Let's hear it from Sir on how they've done this quarter. Welcome to the show, sir.
Yeah, good morning, everyone, and welcome to all your viewers.
So your profit rose 12%, and overall, but sequentially it is down 11%. I know. As an insurance company, you don't have to really look at it sequentially, but just trying to understand that is there some element of the cyclone effect which has kind of impacted the net profit this quarter, or is there something else which is impacting the sequential profits?
So that's definitely a great question, and as you rightly said, the insurance business is all about cycles, and hence to that extent, there's a lot of things that go into a quarterly numbers, and that's why we always keep urging to ideally look at numbers over periods over 3 to 5 years. Definitely not on a quarter-on-quarter basis. If at all you have to look at it more on an annual cycle, at least at the minimum. But ideally over 3 to 5 years is what one would urge to look at the numbers. But having said that, to answer your point in terms of how do we see the Q1 numbers play out for us, I think we are very excited and happy with the way how things have progressed. And the reason why we say this is, I think clearly, let's say from a growth standpoint, we have had an industry-beating number, and the industry grew roughly at about 17.9%, a shade lower than 18. Our growth at an aggregate level was 1% higher than the market at almost 18.9%. So clearly, we had an outperformance in terms of growth. And in line with the current accounting stipulations, whenever you see periods of high growth, the relative cost of acquisition that you have to incur for sourcing the businesses, they come and hit you upfront. So which is why from an absolute underwriting, or let's say from an absolute profit numbers, you would possibly see an expense strain, because the earnings of the growth that you have exhibited tends to play out over the contract period, or let's say over the 12-month cycle, whereas the cost is hitting you on day one at the time when you're sourcing the risk. So which is why when you look at the numbers on an absolute basis, whether you look at it year on year or sequentially, whichever way you look at it, this you need to kind of factor in for this impact. Exactly for this reason is why you need to that gets largely adjusted when you look at the combined ratio numbers, and which is where you would see for us, for ICICI Lombard, the combined ratios for Q1 has been better at 103.8%. This number, if you would looked at Q1 of last year, was at about 104.1. And even when you look at, let's say, for Q4 of last year, that number was slightly higher than 104% plus. So clearly, directionally, I think sequentially or year on year, whichever way you look at it, we have actually seen an improvement in the overall combined ratio. And to your point, yes, the absolute profit also does get impacted by some of the losses from the cyclone events that we have seen in Q1. Last year, Q1, thankfully, we didn't have any of major events play out. But this year, of course, Cyclone Biparjoy has had an impact, which is the number that we also put out as a part of the deck. We had a net claim impact of almost about 35 crores. Roughly about 380 claims that we had on account of Cyclone Biparjoy. The good news is, as a company for ICICI Lombard, we have been very, very proactive in claim settlements. So while I said on the cyclone, we had almost close to about 380 cases, more than 70% of those claims have already been settled. So which also results, let's say, into an outflow, and that's also getting exhibited in the absolute amount of profit numbers that you spoke about. But as I mentioned, directionally, if I were to exclude the impact of cyclone losses from the combined ratio numbers of 103.8, our reported combined would have been actually 102.9.
Okay. So then we can say we are inching towards very close to the goal that you've set for FY25.
So honestly, yes. Yeah, I think that's directionally, that is what we had spoken even earlier. I think last year, FY23, as I said, full year, we ended the book with a number slightly higher than 104. And directionally, we had said, as you mentioned, over the next 2 years, which is by end of FY25, is where we would want to see the combined at about 102%. So directionally, that is the trajectory that we want to take. And hopefully, I think we are kind of pretty much on track to achieve that. Having said that, I would only kind of caveat to say that we obviously will have to wait and see how some of the other catastrophic events play out. Because already we have seen, let's say, again in Q2, there have been significant flooding which has happened in North India. Too early for us to really see how the impact will play out. Early days, I mean, claims are getting trickled in. But having said that, we will wait and see how much of an impact does some of these events happen.
So what is the kind of growth that you're envisaging for the whole year of FY24? I mean, you said we're higher than 1% for the industry. Is that expected to continue? What are you pegging it at?
So let me put that in the context of the pillars that ICICI Lombard has in terms of its positioning to capture the opportunity of growth. Now, let me put it at a macro level first. If you look at a macro level, my market share is at about 8.3% as a company. So therefore, there is enough and more headroom that's available for us to kind of grow the business. Now, within that, if you look at what are the key levers which will help us drive that, I mean, clearly we have the distribution strength to our advantage. We have been kind of significantly investing in technology at scale, which will help us drive efficiency and productivity in terms of operations. And three, as a company, we have been very, very proactive in significantly investing on claim service. And that's the reason why when you look at our net promoter scores, you look at our the time that we take to settle claims, etc., all of them have been kind of significantly positive. So all the right pillars is something that we have always had in order to drive growth. It's just that at times, certain segments, market tends to get very, very aggressive in terms of pricing. And therefore, consciously, we kind of calibrate some of the growth in some of the segments where the markets are very, very aggressive. Now, at this point of time, as I mentioned, Q1, we have been able to kind of beat the industry growth. Going ahead, assuming the market continues to remain sensible, then our expectation has always been to have at least 1 to 2% growth numbers higher than the market growth percentages. That's a thought process. And the reason why we believe this is possible is because the regulator has now put in place a new expense of management guideline that is effective from April 23. And while we have the full year numbers for every player in the market, so when you look at the expense of management for the market as a whole, almost 2/3 of the market or 2/3 of the non-life industry players are having an expense of management higher than the threshold. Now, clearly, the regulator has also said each of these companies will have to bring down their expense of management numbers below 30%. So that again is an opportunity. As the player starts to kind of work on this path, it again presents us an opportunity for growth, which is what I said. We would obviously want to see at least 1 to 2 percentage points higher than the industry growth numbers.
I understand you all are at a 26.6% EOM. So there's still a headroom until 30%.
Absolutely. So as a company, we have always been kind of operating at a threshold which is well below the expense of management guideline. And as I said, if players start to further work on bringing down their expense of management, then the focus becomes more on service and distribution, where clearly ICICI Lombard has the inherent advantage.
So now when you have that sort of headroom, I understand that the company was very interested in penetrating further in the motor insurance space. So what is happening there? I mean, of course, compared to last year, your motor insurance operating profits have at least doubled. So are we putting in more resources towards that particular segment? What are the categories that also our premiums have gone up by 12%? So what is the line of business that is seeing more response versus the others? If you could just give us some idea.
Yeah, I think that's a great question. So if you ask us, let me put that in context. I think over the last couple of years, as I said, the market in motor particularly has been very, very aggressive. And that's evident from the industry combined ratios. If you look at industry combined ratios for first half of last year, that was at about 124%. If you look at the second half, we had said there is some bit of easing that we had seen in the market, which is why second half of the year, the industry combined is at 118%, roughly around that. So there has been some improvement, but still it is at an elevated level. And hence, to that extent is where we have been a bit more guarded in terms of growing our motor portfolio. But the good news is if you look at for ICICI Lombard sequentially, I think we have been able to arrest the extent of growth that one has seen. Just to kind of make my point, if you would have looked at the numbers for the month of April, for motor, we had a degrowth. In the month of May, we had a positive growth of almost about 6%. For the month of June, we had a growth of about 11%. So sequentially, I think we have been able to kind of clearly demonstrate growth resurgence kind of coming back. And within this, the growth is largely emanating from the new private car segment, which is where we have been inherently having a significant strength in terms of sourcing. Two-wheeler, when you look at the numbers coming in from the OEMs as well, while it indicates a directionally positive change, but it is still not completely out of the woods. When you look at month-on-month numbers in terms of two-wheeler sales, it is still lower than, let's say, pre-pandemic levels. And as and when that comes back, we are rightfully positioned to capture the opportunity even on the two-wheeler space. Commercial vehicles, if you look at that particular segment within motor, right now we are again being a bit more guarded because even this year, which is for 23-24, there has been no price increase in motor third party. The moment there is no price increase, then automatically you have to recalibrate the approach that you want to take in writing that particular segment, which is why of the overall motor premiums that we have sourced, the mix of CV for Q1 stands at about 21%. So that's what has kind of aided growth. But the earlier point that I made in terms of expense management trajectory for the market starting to improve, once we also see that playing out, hopefully the regulator will start looking at each of the companies post their Q1 earnings being announced. I'm sure the regulator will kind of want to see that each player in the market are bringing down their expense of management. So hence, we are rightfully positioned. Directionally seems to be very, very positive. And that's how we are kind of positioning to capture the opportunity for growth in motor.
So also the question on the premium side, where exactly are you seeing, from what segment are you seeing growth coming in?
So as I said, the new private car is a segment where we are clearly kind of seeing growth.
So are you saying that only the motor segment is where we are seeing growth? I'm talking about overall lines, say fire, marine, commercial.
Okay. I thought in the context of motor. So maybe let me kind of put it across all the segments. So let me again put this in context. If you look at as an industry broadly, there are 4 key lines of businesses, right? You have motor, you have health, you have commercial lines, and you have crop. For us, motor, health, commercial lines, all of them are preferred segments. And which is why pretty much on the rest of the 2 segments, which is health and commercial lines, we have had almost industry beating numbers, almost 2x. If you look at commercial lines for Q1, industry growth was roughly at about 8%. We had a growth of almost about 17%. Again, this is span across all the segments of commercial lines, whether you look at fire, marine, engineering, liability, across segments, I think we have been able to continue to accrete market share on the commercial line space. Engineering, again, been far more significant levels of growth, thanks to the trust that the government has been making on the infrastructure investments. And therefore, that translates into an incremental opportunity on project insurance. So which is why within the commercial lines, the engineering line of business is doing phenomenally well for us. But as a category, I think, as I said, we have had almost 2x growth in the commercial line space. Now, let me go to health. Health, when we talk about, largely we talk about 2 segments, which is the employer-employee, or let's say the corporate health. And then if you look at the other retail health segment as well. On the employer-employee, again, we have had 2x growth relative to the market. I mean, as a health as a segment, industry grew at about roughly 20%. For us, the overall health grew at almost about 40%. Now, if I break down into the employer-employee category, that segment for Q1 grew at almost about 44%. This has been an all-round beat, primarily again because it has been a growth driven by increase in price. It has been a growth that was driven by increase in volumes. And 3, thanks to the market, some of the players have started to get far more sensible. And hence, to that extent, it has also been an accretion in market share. So that's the reason we have seen a growth of almost about 44% in the corporate health space. On retail health, that's been an area of investment which we have been doing for the last couple of years, at least on a serious basis. And that will be a continuing one. Again, very happy with the way how the progress of those investments have played out, because on retail health indemnity, we always had a market share which was less than 3%. The good news is over the last, let's say 9 to 12 months of our investments playing out, already we are seeing green shoots in terms of a market share improving to 3.1%. Still a long headroom to kind of catch up. But at least the good news is we are able to see some of those investments already reflecting again industry beating numbers. Just on the retail health, again, we had almost about 23% growth in Q1. Industry growth on retail health was about 18%. So hence, it's been an all-round kind of beat. The only segment where we are a bit guarded, as I said, has been motor. But there again, I think we will wait for how things play out in terms of the expense of management guideline getting reflected.
Now, so I have 2 questions, 2 follow-up questions on segments. So if we look at the retail health segment, it's still under an operating loss. Now, we had taken a price hike in February, if I'm not wrong. So since then, it was expected that, the losses would narrow further, and then, we are expecting some profitability, but that hasn't quite panned out in the first quarter yet. Also, if I were to look at the group health business, which has shown, of course, phenomenal growth, like you mentioned, but the losses have widened. I mean, over last quarter, over like the June quarter last year, it's almost up 4 times. So what exactly is happening there? Why have the losses gone up so much? Well, now with COVID behind us and things normalizing, this sort of loss, so is it that we've underwritten some businesses, some really risky propositions? Why is it that it's widened so much?
I think great observations. So honestly, I think let me answer the first one for, on the retail health space, which is the original point that I mentioned in terms of the why, let's say, the absolute profit numbers would have grown only at 12% for the company as a whole.
Yeah.
When I kind of responded to that, I had said whenever growth comes back, you obviously start to see, let's say, the acquisition cost coming and hitting you upfront. The same explanation holds true for retail health. Because we are making investments, effectively, we are kind of significantly investing in increasing our headcount, which is employees who will be engaged in the health agency distribution, is what we are getting on rolls. Whereas the benefit in the form of revenues will typically trickle in over a period of time, because these employees will in turn go to the market, get agents on board who will start becoming productive, and therefore you will start seeing revenues play out. And that's the reason why when you again look at it from an absolute outcome, from an underwriting standpoint, you will obviously see, let's say, numbers far more elevated. And that's the reason why when we look at the numbers, we look at it in the context of what has been the loss ratio experience of the book that we are writing, just to kind of make sure that we are not writing any, exactly to your point, on are we really picking up any riskier segments in the way we are underwriting the portfolio. Now there, if you see clearly, whether it is Q1 last year or whether it's a full year or whether you look at Q1 of this year, generally our retail health loss ratios have stayed in that range of about 64-65%. The range that we have been comfortable writing has been in the range of 65 to 70. But as of now, I think the number that is getting reflected is at about 64%. So hence, the underlying risk that we are assuming as a part of that portfolio is we are quite okay with what we are underwriting. We are not necessarily taking any riskier proposition. But purely from an absolute underwriting outcome, the moment you make any investments in distribution, the cost hits you upfront. The benefit of revenues will come through over a period of time. So that's the reason why you find, let's say, an absolute underwriting reflecting an adverse trend. The same, let me now come to corporate health. Again, there, to your point on, are we really assuming any riskier underwriting? Honestly, not. And the reason why I say that is primarily because when I said the growth of 44% has been all round, including accretion in market share, some of the market participants in the past had gone very aggressive in writing this particular category of business, and they lost a lot of money. And clearly now there has been public circulars issued by each of these market participants to their operating offices to get better on underwriting, which means the focus now starts to shift to service, and it also comes at a price at which we are comfortable with. And that's the reason why we are continuing to accrete market share, because ICICI Lombard as a company has been known significantly for its claim service capability. And we are equally happy with the way at the price at which we are comfortable in terms of getting those premiums. Now, again, a reflection of the loss ratio of the corporate health book. When you look at the, again, I will, as I keep saying, don't look at quarter numbers, but just for the sake of responding to your point, if you look at Q1 numbers of corporate health loss ratio, that number stands at about 92%. This, if you look at for the full year of last year, that number was at about 95%. So we actually seen a decline in the corporate health loss ratios relative to what we had seen in the past full year. So hence, to that extent, we are not necessarily writing anything significantly riskier. And again, we are quite okay with the range of the loss ratio experience that we are seeing in writing this particular book.
So if I were to understand this correctly, you expect these widened losses to smoothen out over the period of the year. Because ideally, to underwrite this business, you don't really need to incur as much expense as you need on a retail health book. So the expense logic would not, I think, work for the corporate health segment.
Absolutely. The expense logic will definitely not work. But as I said, on a full year basis, when you look at the numbers, the range of the loss ratios that we are writing, we are quite comfortable with that. So we are not necessarily taking any increased riskier exposure in that segment.
Fair point, sir. So one more thing, there was a lot of talk around the hardening of rates on reinsurance side, especially for commercial lines of business. So how is that panning out? And again, on the fire side of things, we've seen the loss ratios for, like, there's a loss of 30% over last quarter.
Yeah.
So does that have anything to do with that? Can you just help us?
Yeah. So again, a great observation. So again, yes. So couple of impacts. So one, let me address the let's say the price change point that we have been talking about. Even in our April earnings call, we did speak about this.
Yes.
For the quarter, the decline in pricing has been a single-digit number in the range of 5 to 6%, which is on expected lines. So nothing significant in that sense. Which is why if you see for fire as a category, for the industry, as the growth has been relatively tepid. It has been roughly at about 6% or thereabout. But there again, if you see ICICI Lombard's growth in fire line of business, we have again grown at almost about 11%, 10 to 11% in that range. So again, we have been able to kind of accrete market share in that particular portfolio. But having said that, yes, there has equally been an impact of increase in reinsurance cost. And what effectively happens is, again, because we are kind of growing the book, the earnings will kind of again come through over a period of time. Whereas my cost of reinsurance that I pay tends to kind of hit me immediately in quarter 1. So that definitely tends to have an impact on my loss ratio numbers. So that is one impact which will smoothen out by the rest of the year as we head into the full year numbers. And secondly, as I mentioned in Q1, we also had impact of cyclone Biparjoy in both fire and let's say the engineering line of business, which obviously has seen elevated loss ratios again when you looked at it relative to Q1 of last year. And if one was to exclude the impact of losses of cyclone Biparjoy from both the fire and engineering line of businesses, my numbers on the loss ratio will look far more better, and it will be pretty much on lines that we are kind of quite comfortable with. So hence both impact of reinsurance cost that has hit us in Q1, which will smoothen out by the rest of the year, and two, the impact of cyclone, which also tends to have an impact in the period whenever these cyclones hit the market.
So my last question, again, since we couldn't get a number on the growth side, if you could give us a number of the growth that you're envisaging for the year. Also now, some ballpark range in terms of which you expect to grow on the PAT side, because this year is going to be an abnormal year in terms of course, the cyclone and now the flooding, and there was a lot of talk about El Nino. So how do you see this year as a whole, the FY24?
So let me address the last part first, which is the threat of El Nino. Threat of El Nino tends to also have an impact on one of the lines of businesses which we didn't speak much, which is crop. So crop as a portfolio, our view is something that we've always talked about. In terms of the overall full year annual revenues, we expect crop to be less than 5% of the overall mix. So hence to that extent, again, whatever we are looking at writing will be extremely calibrated. And as we speak, currently we have an exposure only in Maharashtra. And that again is under the 80-110 scheme, which is operating within a particular risk corridor. So hence, to that extent, we are again taking a calibrated call. And as I mentioned, on a full year revenue basis, exposure to crop will be less than 5% of the overall revenues. And primarily exactly also for the reason that this could be a year of potential El Nino. Now, coming back to your couple of other points in terms of what could be the growth percentage and in terms of revenues as well as in terms of profit growth. Honestly, as I think, as we keep saying, for ICICI Lombard, the market share is 8.3%. There is enough and more headroom that's available for us to grow, and we have all the right levers to kind of capitalize the opportunity. The way we would look at is, as we keep saying, to kind of outperform the market by that 100 to 200 basis points. How much that growth the market delivers, I think we would obviously want to see us outgrowing the industry as a whole. Because let's take commercial lines. The government is significantly putting a lot of thrust on infrastructure. I mean, that's a huge opportunity. So the market will grow. Within that, I think we are better placed to capture the opportunity. So hence, we would look for an outperformance. Similarly, on health, thanks to COVID, there has been a continued demand for, let's say, having a health insurance covered. So hence, and that's again kind of playing out very well in line with what I just mentioned. So there again, we would obviously want to look at beating the industry numbers. Retail health or investments are again kind of starting to kind of reflect better growth outcomes. So we would obviously want to grow, continue to grow faster than the market. So rather than giving a particular, we don't specifically target a particular percentage of growth to kind of work on. Rather, we would look at us relatively growing better than the industry insofar as revenues are concerned. Now, to your point on what does this translate into profits? Again, it will be a function of what that growth number is. the more you are able to grow faster, to that extent, it will tend to have an impact on my absolute amount of profits because my cost will come and hit me upfront. And a large part of my business today, roughly about 70-75% of business is retail. So therefore, which relatively tends to have a slightly higher cost of acquisition compared to the commercial line of business. So hence, my cost will come and hit me upfront, which is why what we have spoken about is when you looked at, let's say for FY23, when we kind of ended with about 104% combined, our return on equity was roughly at about close to 16-17%. And what we have been telling the market is once by FY25, when we want to get to that combined of 102, that should roughly translate to an ROE in that range of 18 to 20%. That's what you would kind of largely look at, because an absolute amount of PAT again is a function of what kind of growth that we see, and therefore it could tend to have an element of an expense strain that can come and hit us upfront because the revenues will get earned over a period of time.
So the ROE for the first quarter was around 15%. So you expect that to inch up to 18 to 19% by the end of the year, is it?
I think, honestly, the range that we would want to kind of get to is to that range of 18 to 20% over the period by end of FY25.
Okay, by FY25. Perfect. Thank you so much, sir. It was a pleasure chatting with you. Would love to connect with you again. See you next quarter, or even we're open for a chat in the anytime during this quarter as well.
Yeah, sure. Thank you so much, and
Thank you so much.
Have a good day. Thank you. Bye bye.